Do you want to buy a house but don't know where you're going to get the money? I have a great suggestion for you, and it could involve something you already have that you don't even know is possible to use. Hello. I am here with my good friend and lender partner, Karen Rymer. She's with Cardinal Financial. You know me, I'm Stephanie with Point Realty. And we are going to chat a little bit today about using a 401k as a down payment. A lot of people don't realize that that is even an option. When you're looking to purchase a home, if you don't have a ton of money saved up, if there is a good time, a good reason to use some 401k funds that you have. So Karen's going to chat with us a little bit about pros and cons of doing that, and then a little bit of the logistics as well, as far as what all it entails and what kind of pitfalls to look for and all that kind of thing. So I'll let you kind of give us a little intro to some of that, and then we'll get maybe some Q&A going too.
Okay. So a lot of times if you're not able to get a gift for a down payment from a family member, or you don't have the funds saved up, and aren't able to qualify for down payment assistance, if you have a 401k with your work or past work, that's a lot of times a great option in order to have money for a down payment and closing cost. The big things with 401k, you can either withdraw from it or you can take a loan against it. The good thing about taking a loan against it is you're paying yourself the interest on it instead of somebody else. So that's a definite plus. You definitely want to check with your 401k provider to see what their guidelines are. Usually it's a 10% penalty if you just withdraw. And then if you do a 401k loan, you want to make sure that you can afford those payments on it.
Okay. Let me make sure I understand. So let's just say I'm pulling out $25,000 out of my 401k. So when you say a 10% penalty, that means from that $25,000, I'm going to lose $2,500. That
you're going to be paying the IRS that normally.
Okay.
Okay,
that makes sense. So when you talk about the difference between withdrawing, so withdrawing is I take the penalty and the money is just gone from the 401k. But if I borrow against it or take a loan from it, how does that work?
There's usually not a penalty. You just want to check with your provider and find out what your payments are going to be, because they are going to payroll deduct that normally. So that's going to be a little bit less income coming in per month as far into your bank account. But you can also lower your 401k contributions while you're paying it back.
So you pay it back on a monthly basis. It's not like you have a certain number of days or months to fund the whole balance that you borrowed.
Right. They'll set up the payment plan and the interest rate that you pay it back at and give you options. So.
Okay, and so that's super interesting though. So you're talking about the interest rate, but you get the interest.
Yes, you're paying yourself back out.
So interesting. So I knew that you could borrow against it and pay it back, but I did not realize it was set up on a monthly payment plan.
Right. So like however you're paid, if you're paid weekly or if you're paid bi-weekly or twice a month, that's normally how they're going to deduct it from your payroll.
Okay.
So, and then also on the 10% IRS penalty, you're going to be also getting, when you buy a house, a big tax break. So that may offset it. So that's something to look at as well, because you're going to be able to write off that interest on your house and write off your property taxes as well.
Right. Well, so to your point, so you've got the interest in the things that you'll be able to write off that could offset it. But I also like to point out to clients often, if they're looking at either breaking a lease or taking some kind of penalty on something, I'm like, well, let's look at that dollar amount and let's look and see if you waited a year or 2 years where you wouldn't have to take that penalty. How much more are you paying for a house?
Right. Exactly.
How much less equity are you going to have? How much time have you lost building equity? So in the long run, yes, it's $2,500 or $4,000 or whatever it is that you're paying to break a lease, paying an IRS contribution on a 401k or whatever it is. But in the long run, was that money well spent?
Right.
Because you were able to get into a house sooner and start building equity at a younger age and a sooner time.
Correct. And we're not seeing housing prices go down. So
we are not. We we are starting to see interest rates go down.
Yeah.
I won't make you talk about that quite yet because we could do a whole new video about that. And I don't want to put you on the spot. But yes, even with interest rates hitting, what was it, a 20-year high a few months ago at almost over 8%. Yeah, so 20-year high at over 8%. Even with that happening, even with the reduction in the number of closed sales and it feeling like the market was moving a little bit slower, we still overall have not seen home prices come down. Year over year, we still have seen, it hasn't been a big increase. It was been a very small percentage, but from 23 to 24, or I'm sorry, 22 to 23, we did see an increase.
And the average increase is about 4% in the Texas areas. Of course, there's been some years like in 08 that you didn't see the big appreciation. You actually probably saw it drop a little bit. But if you look at the scale over the last 30, 40 years, it's an average of 4%. So yes, you're losing that.
Yeah. So I think that's a great alternative to be aware of. And just because we're talking about down payment, and 401k is a creative way to source your down payment if you have one. I will just point out also, it is another, I think, common misconception that you have to have 20% down to buy a house.
No, you do not.
Which is absolutely not true. So when we're talking about the 401k and what you would need to pull out, and if you're nervous about borrowing against your retirement, don't look at having to take 20% out. Look at if you're doing an FHA loan, it's 3.5%. On conventional, there are still some products at 3, right?
Correct. First time buyers, and depending on what income range you're in.
Okay, so there are some conventional products at 3% down, and then
if you're a veteran,
a VA loan, that's a 0 down. So you do not have to have 20% down. So if we're talking about borrowing from your 401k, it makes you nervous to have to borrow against retirement, which I get. I'm all about funding retirement. Don't put yourself in a worse off position later on. But also, I keep coming up with these other points I want to point out. If you are a homeowner versus a renter, your net worth, I think the difference is literally like 60% or something. Like the net worth of an individual who owns a home versus renters, it is 60% higher. If you are, it's got to be more than that. I don't know. I think that's the last statistic I heard. But anyway, so borrowing against your retirement maybe makes you nervous, but also think about your net worth in the long run if you are a homeowner.
I'm sure you have financial advisors that you can refer them to as well as I do. So we can have somebody help you make those decisions as well.
Absolutely. So the whole point of this video was to talk about 401ks. I just wanted to point out a few other things about down payments as well. So you don't have to have 20% down. You can borrow against your retirement. It may or may not be the right decision for you, but if you want to talk about it, please call myself or Karen and we can talk you through it and decide what the next best step is. And let's make 2024 the year you become a homeowner.
Definitely.